chatting about some more of my strategy, I guess if you want to call it that, but this is going to be kind of the opposite spectrum. So if you haven't seen the other video already, I discussed kind of my passive investing portfolio strategy. I think it should be 2 weeks ago where I uploaded the video. In the video I do mention that I have other plans, obviously, for investing, not just super passive, because, or should I say, like you don't want to obviously be too low risk, but so this video is going to be, I say the other portfolio because it's not necessarily, everything is the same portfolio, if that makes sense. It's me. What am I doing? But this video I wanted to talk about the stuff like Pokemon and Yu-Gi-Oh! And more speculative stocks that I put some money into. And I guess kind of break it up like that. So if I haven't seen the other video, so let me actually do this. In the other video, so over here we have the, I'll say passive slash risk adverse portfolio. Try to write a little bit neater. I got a better pen. I think this one's a little bit better for, it's a finer point, so it's less, what's the word? It smears, I guess. So this is the portfolio where we discussed the other week. And I'm gonna say a lie, but it's because I'm working towards that, and it's what I kind of wish the percentages were, but they're just not because of all the, I bought so much Pokemon stuff years ago, and it's just so expensive where it's literally inflating everything else, but we're working towards that. I want this portfolio, let's say, to be, I don't know, 75, say 70 to like 85% of my investments, I guess. So that leaves 20, I guess that's a huge number. But yeah, it fluctuates somewhere, probably like 75-80%. Do 70 to 80, somewhere in between there. I want the rest of the portfolio to be in safer. Sorry. I want the rest of the stuff to be. I guess I'll do it here. This is what today's video will be about. Let's say speculative. Right now, I think my speculative is much higher than this. Maybe not, but why does my cat always have to eat when I record? She was sleeping the whole time. Anyway, let me just, so I don't forget. Here we got stocks. We got collectibles. We got mostly metals. I don't think there's really anything else. I'm not gonna put like, yeah, this is investments. I mean, technically a business or something is an investment. It can be, but it's not. I feel like this is more about things you buy. There's definitely a separation between that, but I don't necessarily know how I want to go about wording that. So this stuff, let's say anywhere from 30% to, oh, I messed up. I want to do 20 to 30. 20% to 30%, somewhere in that range. Obviously things fluctuate, but if it gets above 30%, probably where I start wanting to, bring it down. So this has got the dividend, ETFs. We got individual stocks, individual stocks. What else? We got bonds. Could be corporate T-bills, doesn't matter. We got high yield savings. I mean, technically like CDs could go in bonds too. There's obviously other types of fixed kind of income things, but we'll just do those for now. Over here, stocks, bonds, metals. I mean, technically metals could be considered. Yeah, here's the thing. Okay, I flow separation. If it in my strategies, if it's not cash flow based with pretty relatively like it's not risky, it goes in this category. If it's anything else, it's here. That's how I'm separating the I guess investments, the individual units in the investment or the portfolio. Where do I want to go with this? Okay, so I don't want to talk too much about that because we already did, but I wanted to outline it in case if people didn't already see that video. We didn't probably see that one first. That one's probably more important. So speculative stuff. Okay, let's actually get into the topic. Stocks, collectibles, metals. Well, actually, real quick, I did make an error in this video. I added all of my cash, I think, in my head. So, like, I included my emergency fund and, like, just any cash I had, but I shouldn't have done that. So the ratios are off. So cash should be like it should be a lot lower percentage relative to these other things, but it isn't. Yeah, anyway, I just wanted to point that out. Stocks, collectibles, metals. Right now, I think most of my I don't like it, but most of my speculative stuff is in collectibles, and again, because it's just because it went up so much in price. I'll say mostly Pokemon, maybe Yu-Gi-Oh, but mostly Pokemon. And metals, it's mostly silver. Yeah, gold is just kind of expensive to own. Yeah, this is the most recent Pokemon purchase. I'm trying not to buy too much Pokemon because I just have so much of it, but I bought a couple, or I think I bought 5 booster boxes of this from Japan. It was like I think 65 a box. I think this box is going to be super nice to own. There's a lot of great cards in this set. Yeah, again, it might go down in price. I'm hoping the boxes go to like 120 or something like that. I want to buy more, but also if they're above like 150, I don't really want to. So that was the thing. I feel like these boxes, again, I'm not saying you should do this. I'm saying for me, I think this set's great. The worst thing that could happen is I just open these up for fun and I try to pull the like super cool cards. I think that box is gonna be pretty expensive in 5 years from now. I don't mind paying $165. I just wanted to own them. I don't want to spend like $200 on them, but $165 was okay. If the price of the box doesn't go down, I do want to pick up some more. So that is considered to me more speculative investment because it's not yielding a consistent return. There's no cash flow in it. So that's that. Now again, the thing, yeah, we can get really, really into this, but the thing with Pokemon and Yu-Gi-Oh, Magic, Flesh and Blood, all these other collectibles are, you can have like 100% return in the product, but when you offload the product is where it's not easy. Stocks, bonds, it's so liquid, it's really easy to also, show your capital gains. If you buy this box for $100, goes up to 200, you made $200, sweet, then you go to sell it, then you got your 15% eBay fees about. If you go that route, then you gotta pay like $10-15 shipping and tracking, eats away your profit, but you're still potentially taxed at the $200 or whatever you sold it at, because that's what that's what eBay is gonna send with your W-2. So when you go to file that, it's just a mess and it's a headache. And again, I'm not a tax advisor. It's just a mess. Or not. Maybe it's not that big of a mess, but it's something where when you compare doing this type of selling and buying and that type of movement, trying to make money, or from an investment perspective, it's like almost buying a stock or bond just makes so much more sense because it's just so much easier to do the paperwork. But again, maybe for you it's kind of easy, but that's why obviously you gotta talk to a tax advisor or figure it out yourself. But it's annoying. But for the long term, though, it's nice. It's fun to own too. Owning this stuff, you get to see it, touch it, hold it, maybe even open it. You can do whatever you want with it, like a stock or bond you can. Yeah, most of it's in Pokemon for me. Some of it's in Yu-Gi-Oh. Silver, I haven't been picking up really any, and my thesis on the whole metals has been. I thought about this in the car ride home. 2018 is where I got on board with the thesis of the whole metals thing. What the heck, my cat just like burped. I got the thesis of the whole metals thing, and now it's 2023. Why I can still not write. I mean, that's not a very long period of time, but I'm trying to say how to explain this. People keep saying the metals are amazing and great, and I made money in metals, and I also lost money, but I just don't know. I think there's a place in it for everyone's portfolio, but very small percentage. I'm talking like 1 to 5% maybe. And I guess I'm doing of this because I want to focus on this separately. This does not yield me any cash flow. I guess technically it can if you buy the dividend ET or the dividend. Oh my god, miners. So you got your miners like NEM. I was gonna say AEM, but now it's I don't know. AEM. They bought KL. What are the big ones? Las Vegas Sands. Again, you can put these into this portfolio. Technically, maybe it depends on how risky or unrisky you think it is, but for the most part, right now I don't own any metal stocks. I only own physical metal, and I don't intend on increasing that position really anytime soon, unless it gets kind of cheaper. But we'll see. Stocks. I want to go back to collectibles in a little bit, but we'll go to stocks now. Stocks wise, so for this section, these stocks, these are companies for whatever reason I like for some reason that don't necessarily fall into this category. Maybe, it's cheap relative to the price to earnings or some reason. Maybe just something happened, the stock dropped, or I like the valuation of it basically. Yeah, I deem it being a good valuation. Good valuation. And it's whatever metrics I deem to be good. Maybe free cash flow per share, or was it was it market cap, the free cash flow, just really anything. Just to be clear, I've been doing a lot less of this just because it requires time, and there's just, to me, there's not no reason, but there's good assets to be bought right now. I don't need to not gamble, but I don't need to add that additional risk to the portfolio or to the money that I earn by doing this. I can just buy better assets. So that's what I'm doing here. Yeah, like low debt, just all that stuff. I'm very definitely I'm more picky with this now because again I don't want to lose money. It's dumb. But again my portfolio now is still in that like transitory, like purgatory period where it's like in between, where I still own things that don't fall in this category necessarily. But I guess I'll go down to here. Stocks. Again, I'm not recommending owning any of these in the current moment because I own them at some point. Let's see. I own them at some point, bought them, and like them, but it doesn't mean I recommend, or obviously you gotta do your own research. Actually, I'm trying to think. Let's do CCJ, sure, uranium stuff. Do like quadruple U. I have like a list of somewhat good stuff. I thought Smith & Wesson up there. Smith & Wesson. Wow, my list is pretty small. Yeah, again, I've been doing a lot less of this. Sure, I guess Intel though. Like Foot Locker, I liked because they had like low. Most of these companies like this, yeah, kind of that. Yeah, actually, yes, CCJ do. They have very low debt. I mean, these are uranium. Really quick, these are uranium stocks. I have yet to lose on a uranium like trade, I guess you could say, but a holding for multiple months. Even CCJ a couple of years I held it, but I sold it because it was just I had a big profit. And I wanted to move the money elsewhere. There's things that I wanted to buy, but uranium did me good. Definitely don't want to get greedy with that, but we'll see. That's just these are the things. I'm not recommending anyone look at the or not buy these, but you can obviously look at them and see if they fit your investment criteria. But Foot Locker, Logitech, Smith and Wesson, they have like absolutely no debt. I mean, Foot Locker actually does, but it's not a lot for a retail store. Logitech, Smith and Wesson don't have like any. Intel's definitely at my heavy trade. I have a lot of shares. I don't even know what I was gonna do, but a lot of shares. I should not own this much. This is, my average price is like $42. Let's say $42. I kept buying all the way down, and now it's been going back up. They cut the dividend too. I'm not surprised. It definitely hurts when you see it. Like my calculated dividend percentage of the portfolio went down like 0.5% to like 1%. It was pretty wild. Maybe not 1%, but definitely 0.5%. Again, it's they make money. This is like my criteria. Good free cash flow per share is increasing. Little to no debt. The market cap, the valuation to free cash flow, let's say from like a 3-year perspective, is cheap. It's gotta have like all of these, and there were like Foot Locker right now. I was up like 30-40%, not including dividends. Now I'm down 25% as of today. The stock was like, Foot Locker was like this. It was like drop, and then like it just went like boom, 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 and then it went boom. I was like, oh my gosh. I was hoping on this earnings it was gonna just shoot up a little bit and get out of their like channel, but it did not, and I really should have taken that profit because even if it did shoot up, like I still would have made a lot of money. Not a lot of money, but yeah, a good amount of money, and I could have put that into the stuff over here. But now I'm sitting at a loss, and it's like, bro, it just stinks. But it's the decisions that I made. So, but yeah, this right now, Intel. I have Intel, Smith and Wesson, and Foot Locker. I actually like Smith and Wesson for more of like a risk adverse thing, but I have Ruger and Smith and Wesson. And I feel like I can't consider them both. Like, I think Ruger's just a lot more stable from like a dividend point of view and like financial stability, but Smith & Wesson, they're not bad either. But I'm gonna lump Smith & Wesson in this category, more speculative, just because it's a lot lower. It's more volatile, I guess I'll say that. Lower market cap. Intel, though, my position's way too big. It's just too big. It's for like a more speculative play, but I didn't deem it as like a speculative play. But yeah, I mean, those of you who are watching this video probably, if you've been around the channel for a year or two, yeah, I've been talking about Intel for a lot. But yeah, I don't regret it. I said I would sit through it till like 2025, so we'll see. We'll see how it plays out. But yeah, I don't think I can lump that Intel into this category just because. Where else are we going with this? So I guess stocks, collectibles, and the metals all together are in this sort of portfolio, and I want it to be 20 to 30, but I think right now it's a lot higher. It might be, let's say at least 40, just, throwing a number out there. It's probably not 50%. I don't think, actually, hold on a minute. I forgot about all the Pokemon. Duh. It's probably above 50%. Yeah, 40 to 50, sure. So I gotta bring those numbers down, and buying stuff like this doesn't really help this out. I mean, yeah, it makes dents here and there, but I really gotta get this, because this is a lot harder to lose, and this, it kind of compounds as long as you kind of mitigate this risk. But at the same time, like Logitech, I think had a 30-40% gain recently. I think it was like 50. I wrote it $50 to 65. Okay, maybe that's not what actually is that percentage. It doesn't matter. or $15 share gain would made some money. Sure. I think it's like 70 now, so I'm dumb. Maybe I'm dumb, but again, made money. You can't time it perfectly every time. I feel like there's some other stuff that I'm missing with this too, but this stuff you can. So okay, this is great talk. This I can spend so much less time doing and have it be relatively a lot more, what's the word, consistent, or I can spend a lot less time working and worrying about this, and I don't lose as much. This stuff you have to spend more time, especially the stocks, a lot more time looking at it, a lot more time researching and picking and choosing, and being more active, which, sure, it's kind of enjoyable at times, but when you lose and you're just like, well, I could have just put all that money into something else and it would have been a lot more chill, if that makes sense. Like, it wouldn't have been that volatile. Sometimes it's not the best feeling. Maybe I'm just a bad stock picker, but again, I win some, I lose some. I think I've definitely won more than lost, but those losses, they just hurt, because it's like, well, I worked for that money, and I did not need to lose that money, and that's, to me, the frustrating part. So, as you, another investor, watching this, listening to this video, like, just something to keep in mind, and, never, that's why you don't, if you play around with this stuff, you might win, great, but, don't go so hard where it's unrecoverable, or, I would never make a trade. Or I would never recommend to a friend to make a trade where if you lose like half of that or all of it, you would be in a very sad state of mind. Like, you can't earn it back in like a month, let's say. I think that's okay. And for the most part, like, 25% loss, like, I think unrealistically, you don't really go much lower than that unless you're doing like a lot of really risky stuff, which you probably shouldn't be doing. But if you can lose, let's say you make like let's say you put $1,000 to stocks every month. I wouldn't bet like a $5,000 trade. Like, I would, you know what I mean? Like, just don't be. It sounds dumb when you say it out loud, but people do it all the time. Just don't lose money. Just try not to lose money. Mitigate the risk, and that's why my stock selection has certain criteria where I'm trying to mitigate that risk as well. Like, if it's a good, like, I'm trying to weeding out if it's a good company or not, based on certain criteria. I'm tired. Is there anything else I need to chat about with this? I really want to open these boxes, but I will be, what's the term? Disciplined, I guess. So, is there anything else? Gonna chat about this. Uranium. It's risky. I think uranium nuclear energy is probably the future, but it's just so volatile. And I mean, like, I can't hold that for I can't hold that for 5 years. That is just that's a trip. Like, that is a ride. If you want to hold that for 5-10 years, like, sure, but like, that is, oh man. And again, they're diluting the shares a lot. That's why these companies have low debt. They don't take on the debt because the banks don't want to finance them, really. I mean, not typically. So they raise the money by investors, and they dilute the shares. So maybe holding on to the company for 5 years is dumb, because your free cash flow per share is actually decreasing a lot. So you actually, can own less of the company. So it's just better to wait until, it's just better to wait sometimes with those things. And I guess that's something I think some people might not understand too. If you think an asset's going to be more expensive in the future, or a stock more specifically, they're going to probably dilute the shares to raise money. Sometimes too, if it's a lower cap company, they know they can make the money. I think, UEC, maybe even quadruple U, but UEC, when that stock shot up to, I don't even know actually, let's just say $5, $6, they diluted the shares so much. They raised so much money. So from a company point of view, They did a great job. From a share stockholder point of view, you did really bad. So there's that like dynamic. Yeah. And that's a little side tangent. Because now the cat's snoring. What is she doing? Anyway, though, good to have a balance. Good to have a balance, but I definitely need to increase this more, and I think the market's just kind of primed for this stuff. I mean, sure you could be more speculative and stuff, but it's like I can just go over here and get a nice yield and be like I'm pretty happy with, let's say, a 4 to 5% yield. That's like pretty almost 100% risk free. Again, it's not,